Lanka's largest state-managed pension fund made out of forced savings of private citizens will be given returns above inflation, and officials said, amid rising concerns over real losses made in recent years.
Central Bank says that the bank will establish a sound risk-return profile to establish a positive real rate of return over the long term.
We will establish a sound risk-return profile to generate a real positive rate of return over the long term.
Sri Lanka's Employees Provident Fund, or EPF, with a balance of 750 billion rupees belonging to more than 2 million accounts, is managed by the central bank. There has been rising concern in recent years over large real losses suffered by the fund, as Sri Lanka's central bank generated high rates of inflation and in the process of printing money to keep interest rates down under pressure from the Finance Ministry. In 2006, the fund made a real loss of 37.6 billion rupees based on a starting capital of 405 billion rupees, an effective rate of return of 10.20% and a year-in inflation of 19.3% measured by the Colombo Consumer Price Index. In 2008, real losses fell to 5.7 billion rupees as the central bank allowed interest rates to rise. By 2009, the central bank brought inflation down to 4.8% and the fund is expected to register large positive real returns for the year. The central bank has also come under fire over conflicts of interest, as the Finance Ministry's debt office is also an agency that comes under the monetary authority. While the EPF suffered massive real losses, its managers, who are central bank employees, are separately compensated by a high-return pension fund which is topped up with central bank profits. There have been calls for independent management of the EPF amid an overall push among the people to change the country's constitution and regain lost liberties and re-establish rule of law.
The EPF has, over the past 25 years, been able to have a higher than inflation return of about a real return of 1.6% over the past 25 years, and the demand for EPF services has increased.
It is not clear what benchmark used to determine the real return of 1.6%. In the recent years, the central bank has been shifting the goalposts to various convenient benchmarks in claiming real returns of EPF. In 2004, year-end unadjusted inflation shot up to 13.8% and the seasonally adjusted inflation to 7.6% as money was printed to largely subsidize oil. The EPF's published effective rate was 9.59%. Compared with the seasonally adjusted inflation, which is an average across 2 years, the central bank said in its annual report that the EPF's real return was 1.99%, and when compared with the commercial bank average fixed deposit rate, the margin was 2.5%. With tsunami aid, government finances improved in 2005 and inflation fell in 2006 amid renewed financial repression, and the fund returned only 10.20%. Unadjusted inflation rose to 19.30% and seasonally adjusted to 13.7%. In the central bank annual report, references to inflation were dropped. So were references to the commercial bank average fixed deposit rate. Instead, the central bank said the return was 3.5% higher than the averaged weighted deposit rate. In 2007, when inflation was again high, the central bank shifted to yet another benchmark. Its annual report said the real return of the EPF was around 1.25% against the seasonally adjusted consumer inflation for the last 10 years. In 2008, the comparisons were provided, but the report said the effective return was 200 basis points higher than the previous year. Cabral said there were plans to include bringing in informal sector members such as farmers, overseas migrant workers, or anyone on a voluntary basis. However, existing members are forced savers who have no free choice and cannot cherry-pick the year of entry or exit. The EPF has been misused to distort market interest rates deeper along the yield curve, helping worsen economic bubbles in the past. In recognition that it's a plaything for the state, the fund is routinely referred to as a captive source in the market.